The S&P 500 is currently trading at about 29 times its trailing 12-month gap earnings. It's also trading at around 28 times its trailing operating earnings. The Shiller P is currently at around 35 times earnings. The forward operating earnings PE on the S&P 500 is around 24 or 22, depending whose operating earnings you use. So what do we make of all this? There's a lot of numbers regarding PE that are thrown around, but I think a lot of investors are confused and don't really know how to interpret these numbers. So in this video, I'm actually going to take the time to really walk you through and to help you think about the PE ratio, what it means, and how to determine what a fair value PE ratio is, both from a relative perspective, from a historical perspective, but more importantly, from an absolute perspective. Because there's actually a way of evaluating a PE ratio which enables you to determine what the fair value PE is in absolute terms. And that's what I'm going to be really trying to focus on in this video. Now, I just mentioned 4 different PE ratios. The Shiller PE, which is at 35 times, the trailing as reported gap earnings, which is at 29.4, the operating trailing earnings, which is at 28.3, and forward operating earnings, which some people quoted around 24 and other people are quoting at around 22. The first most important thing that you have to do as an investor when you hear the word PE is that you have to understand what PE is being referred to. Now, the PE ratio is always the price divided by earnings. There's only one price that PE ratios are based off of, which is the latest price that traded in the market. So the difference between these PE ratios is in the denominator. It's in the earnings that these different PE ratios differ. And these earnings all tell a different story. And so it's very important that you actually understand which earnings is being referred to when a PE ratio is being quoted. Now, there are basically 2 main types of earnings that are generally used to calculate PE ratios. And it's very important that you know which of these types of earnings is being used when someone is quoting a PE ratio. Now, one of these types of earnings is called the as reported gap earnings. These are sort of the official earnings. They go by generally accepted accounting principles. That's GAAP. And so these are the earnings that companies, when they report their financial statements, they're legally required to report their earnings in this particular fashion. It is a fairly conservative method of accounting, and it sometimes can result in earnings being a bit lower. Particularly, the earnings will sometimes look lower than what the long-term earnings power is of a company, because what happens with GAAP earnings is that when companies take one-time charges, when there's unusual charges that they have to make, they actually have to deduct that from their earnings. And so that can actually affect the earnings of companies under GAAP, and it can make their earnings appear lower at any given point in time than, let's say, their potential earnings power. So that's why something called operating earnings was developed over the years, where analysts try to take out these one-time charges to get a clearer picture of what the actual earnings power of a company is. Now, the problem with this is that by taking out these various charges from earnings end up being overstated, because these charges that are being taken out are actually economic losses that are being suffered by companies and their shareholders. So it's like taking out all the bad stuff. And when you take on all the bad stuff, obviously what you're going to end up with was a sort of a rosy picture regarding earnings. So that's the downside of this. The upside of operating earnings is that by taking out these sort of one-time charges, you get a better sense, you get a smooth sense of what the earnings potential is of the company. But if you look at the earnings in the long term using operating earnings, it's going to give you a little bit of give you an elevated level relative to economic reality. Now, in any given specific point in time, GAAP earnings is going to give you a figure that may understate the earnings potential, but over a long period of time, GAAP earnings are actually going to correspond with the actual economic earnings that companies are earning. So really, it very much depends which one of these earnings you use, depends what your purpose is. If your purpose is to focus on long-term earnings potential, then you should focus on the GAAP earnings because this is a better reflection of the economic income that is generated by companies over time. It actually includes losses and these one-time charges that are actually economic losses. But if you smooth that out by looking at the GAAP earnings over a very long period of time, it actually paints an accurate economic picture. However, if you're looking to look at what the earnings potential of a company is over a short period of time, when you're just looking at, let's say, 1 year's worth of either trailing earnings or forward earnings, then it might actually make sense to focus on the operating earnings because these one-time charges can make a huge deduction on earnings and make it seem like a company has very little earnings potential because you're just looking at 1 year's worth of earnings that has a big deduction on it. So that's the reason that analysts generally prefer to use operating earnings. When you're talking generally to anybody in the stock market and they quote you a PE ratio, it's generally based on operating earnings. That is the figure that analysts on Wall Street are focused on. That's the earnings figure that they actually try to forecast and estimate. They don't really try to forecast these one-time losses because by definition, one-time losses are very difficult to forecast. So what they try to do is they try to forecast operating earnings, and the PE ratios that are generally quoted in the market are based off of operating earnings, whether it be the trailing PE or the forward PE. Now, that brings up another subject. You need to know whether we're talking about the trailing 12-month PE, sometimes referred to as the TTM PE, or we're talking about the forward PE, which is sometimes called the NTM, which is next 12-month PE, which is based on the next 12 months of earnings. These two things are very different because we're talking on the one hand about earnings that are from the past, that's the trailing PE, and the other is talking about earnings that will accumulate over the next 12 months, but that's just an estimate. Nobody knows whether those earnings will actually be that high, but they might actually be higher or they might be lower. So again, here, you have to be careful what you're looking at. The trailing earnings is a number that's official. Companies have to report this legally, and you know that you can trust that number as being accurate. However, as I said, it may include one-time charges and it may distort a little bit what the earnings potential of a company is. Now, on the other hand, if you're looking at operating earnings, the reason to do that is generally as investors, we're not really concerned about the past. We don't really care that much about what companies are earning in the past. We care about what they're going to earn in the future. We care about how much a company is going to grow in the future. So that's why we like to look at least 12 months ahead. And that's why operating earnings 12 months forward is the most popular number. It's the most popular figure to use when you're talking about forward earnings. So again, all of these different types of earnings, whether you're talking about the trailing operating earnings, the forward operating earnings, the trailing as reported GAAP earnings, or the as reported GAAP earnings that are projected 12-month forward, whichever one of these four types of earnings you use in a PE or that you hear used as a PE are going to be telling a very different story. It's very important that you be aware of which one it is. And depending on the circumstances, using one or the other might be more appropriate. Now, admittedly, it's a little vague to say that it might be appropriate to use any one of these four different types of earnings. And there's even other types of earnings that you can use to calculate other types of PEs. It's a little bit vague to say that any one of those can be appropriate at any given point in time, but that's actually the truth. So in order to not be entirely vague, but also taking into account that we can't go into great detail in a video like this, I'm just going to provide maybe a little bit of guidance on what you should be looking for when you're making the selection of a type of earnings to look at a PE ratio and what the different PE ratios are actually most useful for. For example, one of the things that PE ratios are used for is to compare the value of companies in a particular sector. When you're generally comparing PEs, you want to compare the PE between companies that are actually in the same sector or same line of business. And if you're doing that, and especially if you're kind of focused on what their most recent earnings have been, either in the last 12 months or in particular, how well you think they're going to do in the next 12 months, then I would recommend using the operating earnings, and particularly the 12-month forward operating earnings, because this is going to give you a cleaner way of comparing the earnings power between companies that are in similar sectors. As I mentioned before, if you use the GAAP earnings and a company happened to take an accounting charge that impacted their earnings, and by the way, some of these charges are non-cash items. They're items that the timing of when to take these charges can be sort of difficult to determine. The exact timing of when these charges are taken and the magnitude of them can be a little bit arbitrary. So, for example, if the earnings of a company are really hit in one particular quarter or even one particular year because of an accounting charge, that's going to make that company look really bad compared to other companies in that particular sector. So that's the problem that operating earnings solves. By looking at the operating earnings, you're getting a cleaner picture of what the earnings potential is of that particular company, and you can compare that to the earnings potential of other companies in that particular sector. If you're looking, on the other hand, at making more of an intrinsic valuation, where you're really trying to look at not the relative value of one company against another at a particular point in time and just using recent earnings, but you're really trying to make an estimate of the fundamental value of the company, then I recommend using the GAAP earnings, but not the GAAP earnings for a single 12 months, which is what's used in the trailing 12 months PE, or even the forward 12 months PE estimated on a GAAP basis. You need to do something that's called normalizing earnings. You need to use normalized earnings. Now, there's various techniques for normalization, and I can't get into that in this particular video. But the idea of normalization is that you take the earnings of a company for a number of years going back into the past, and you kind of smooth out those earnings by averaging them. Sometimes you can use regression. There's different types of techniques that you can use in normalization. And you can also make projected earnings in the future. And again, smooth out those earnings using various different types of techniques in order to come to an estimate. And that's all it's going to be, an estimate of what the normalized earnings power of a company is, for example, based on their earnings right now. And in particular, usually we're trying to look at the normalized earnings power on a 12-month forward basis. Now, that's very important when you're thinking about a PE ratio from a fundamental perspective in terms of what a company is worth. Because when you're trying to think about what a company is worth, you're not focused on just 1 year of earnings. Remember, a company is worth the discounted value of all of its earnings into the future, actually out into infinity. So focusing an analysis of valuation on just 1 year's worth of earnings, whether it was the last 12 months or the next 12 months, doesn't make any sense. You need to get a sense of what the earnings power is of that company. And to do that, you need to look at a longer history, and you do need to look further into the future. And as I mentioned, the GAAP earnings are a better reflection of the economic earnings that are earned by a company. So when you're trying to make this type of analysis of what normalized earnings is, it makes sense to focus on GAAP earnings. Now, many of you have probably heard of something called the Shiller PE ratio. Now, what is the Shiller PE ratio? I just talked about normalization. The Shiller PE is based on a specific technique of normalization that has been employed by Robert Shiller, who is a Nobel Prize winner in economics, not because he developed the Shiller method of earnings normalization, but because of other things he did. It was actually Benjamin Graham who initially popularized this particular technique of normalization, which is which involves averaging a number of years of past earnings. But in the case of the Shiller normalization technique, he doesn't just average earnings going 10 years back. The Shiller PE is based on trailing earnings going 10 years back. He adjusts those earnings for inflation because obviously, if you're looking at earnings from 10 years ago, there's been inflation and those earnings will appear to be very low. And so he actually adjusts them for inflation. So it's a little bit more of a realistic picture of the earnings power of a company or an index, because the Shiller PE, he developed it to actually try to value the S&P 500 index. And so in order to value S&P 500 index, you don't want to just focus on 1 year. You should focus on a number of years. But again, due to inflation, if you go too far back, the earnings are going to be distorted. So in order to avoid the distortions caused by inflation, he actually makes this inflation adjustment. That's an example of a type of normalization. Now, in a completely separate video, I'm going to take a really hard look, analyzing very carefully the Shiller method normalization and the Shiller PE. And I can tell you that there's some very severe problems with this particular method. I'm not going to go into it, but I just wanted to point out that that's the most popular method of normalization out there, but there are others. And that's the topic of another video. And it's a really worthwhile topic because properly normalizing earnings is absolutely fundamental for getting a sense of what the true earnings power, what the true earnings potential is of a company. So employing the right normalization technique and learning how to do that is very important and it's very powerful. And this gets back to what we were talking about before about a PE ratio. If you are looking to get a sense of what the fundamental value of a company is, and you want to use the PE ratio as a metric, the E that you have to use is a normalized E. It's a normalized earnings. Because again, if you're looking at fundamental value is based on an estimate or a projection on the earnings power of a company going many years into the future, decades, even hundreds of years into the future, potentially. You can't just focus on earnings in the next 12 months or the last 5 months. You have to have a technique for normalizing earnings and understanding what the earnings power of that company is in the present, which gives you a basis also for thinking about the growth of earnings in that company, but the growth of their normalized earnings. Now, I mentioned at the beginning of this video that I want to focus on intrinsic valuation, or the valuation of a company or an index on a fundamental basis in absolute terms, not to just use it to compare a company or an index against its own history or against other firms, because you can compare the PE ratio of a company to another company, but that doesn't tell you whether the stock is expensive. It'll tell you whether it's expensive relative to the other company. But for example, both might actually be expensive or both might be cheap. So using PE to compare things doesn't tell you anything about its absolute value. The same thing when people use PEs to compare the PE today to the PE many years ago, or to, for example, the average PE over many years. For example, people say, well, the average PE over the last 100 years for the S&P 500 has been 15. And currently the trailing gap earnings based PE is around 29. So therefore the S&P 500 is about 90% overvalued. That's not exactly accurate. What it means is that it's 90% more expensive than it was on average historically. That's a historical figure. That doesn't actually tell us what the S&P 500, those 500 companies in the index are actually worth, because that historical figure of 15 might reflect an undervaluation even historically, But it also doesn't tell us anything about now because things might actually be, there might be good reasons why things are, for example, more valuable now than they were in the past. That's why I want to focus on intrinsic valuation, because PEs are generally used for comparative purposes, to compare against other companies in the same sector or to compare the valuation of a specific company relative to its past or the index relative to its past. So as I mentioned before, we're going to focus on intrinsic valuation, and we're focused on intrinsic valuation. The first thing we need to do is to estimate a value for normalized earnings. And it's going to be based on that. Then we need to apply a fair value PE. We need to know what the appropriate PE ratio is that should be applied to normalize earnings. And so that's what I'm going to focus on in the next few minutes. So you apply a fair value PE to an estimate of normalized earnings. So what is the fair value PE? Now, I'm just going to briefly go over this, and then I'm going to go over this in a lot greater detail in my community, which is a free community that you can join if you subscribe to my free newsletter. And this is obviously a subject that I go into in great depth in my subscription service on Seeking Alpha and the Seeking Alpha marketplace called Successful Portfolio Strategy. But very briefly, I'm going to outline some of the major ideas, and I'm also going to have some videos in the future that go into greater detail on how to calculate the fair value PE. Now, the way to calculate the fair value PE has essentially two components. The first component is to estimate what the normal PE is. And I'm going to explain what the normal PE is. The second component is of the of figuring out what the fair value PE is to calculate the premium or discount that a company or an index should have relative to the normal PE. Okay. So it's just a two-step process. You estimate what the normal PE is, and then you figure out what the discount or premium is relative to the normal PE. Now, what is this discount or premium based on? It's based on what we call abnormal earnings. What are abnormal earnings? Are also abnormal earnings growth. Abnormal earnings or abnormal earnings growth are based on profits that are earned at a rate that is above the cost of capital. Okay. So if a company makes investments and it's able to earn in excess of its cost of capital, that's what's called abnormal earnings. Now, abnormal earnings growth is based on the idea of normal growth. Normal growth is the growth that a company achieves by making investments and increasing its earnings by making investments that earn the cost of capital. But if the earnings growth is achieved by making investments that achieve higher rate of return than the cost of capital, then this is abnormal earnings growth. The premium or discount that companies should be awarded in the marketplace relative to the normal PE is based on abnormal earnings and abnormal earnings growth. It's very important. And there's a very important distinction that needs to be made, and I'm going to go into this in great detail in another video, between the idea of growth and abnormal earnings growth. Companies do not deserve any sort of premium simply for earnings growth. They only deserve a premium for abnormal earnings growth. Now, let's make this distinction right now. If a company grows its earnings by simply investing capital and earning the cost of equity or the required rate of return, then no premium is deserved for those earnings. It's just like you're spinning your wheels. If a company is taking its earnings and investing it in projects that earn the cost of capital, it's not actually adding value. Now, a lot of companies, what they actually do is that out of their earnings, instead of paying it out to shareholders as dividends, they retain this earnings and they invest it in projects that earn less than the required rate of return, less than the cost of equity. And so when a company does that, it's destroying value. That's what's called value destruction. However, the company is actually growing its earnings, but many companies grow its earnings while they're destroying value. Why? Because growth is expensive. If you want to grow, you generally have to spend money. But the question is, what is the return that you're getting on that money that you're spending? If you're getting a rate of return that's lower than the cost of capital and you're just spending money like crazy to grow, a lot of people confuse that and say, oh, this company's growing a lot. That's great. They deserve a high PE. But again, that's false. Nobody deserves high PE ratio or a PE premium based on earnings growth alone. No, it can only be earnings growth that is achieved by making investments that earn a rate of return that's above and beyond the cost of capital. Companies that grow, but are growing in a way that's actually destroying value, actually deserve a discount in their PE ratio. Again, we start from the normal PE, and I'm about to talk about that in just a moment. And then we apply a discount or premium based on abnormal earnings growth or abnormal earnings. Now, I just mentioned the concept. I'm not going to get into right now how you calculate abnormal earnings growth. That's a subject of another video, and I'm really going to be getting into it. But right here, I think just conceptually, you can understand pretty clearly what abnormal earnings are and what abnormal earnings growth are without me having to go into exactly how this is calculated. Now, let's talk about what the normal PE is, because the normal PE is the anchor for all valuation and certainly all PE valuation. Whenever you're talking about a PE ratio, the first thing that you should have in mind is what is the normal PE for this company or what is the normal PE for the index? The normal PE is simply the reciprocal or the inverse of the cost of equity or the required rate of return. So for example, if the required rate of return on an equity investment is 10%, in other words, you expect a return of 10% annually every year for investing in a stock, then the normal PE for that stock is 10 because it's the reciprocal of 10%. Now, if your required rate of return or 5%, then the fair value PE, or excuse me, the normal PE would actually be 20. If your required rate of return is 6%, then the normal PE is 16.67. And I'm going to explain how this works in a minute. A very important point, which I'm going to get into again in another video, is that when I'm talking about the return, it's the real rate of return. In other words, it's a real rate of return that excludes inflation. So when I'm talking about the required rate of return being 6%, it's 6% real. If there's 2% inflation, then the nominal rate of return would be 8%. But the normal PE, for reasons I'm going to have to describe in another video because it's a long subject, the normal PE is not based on nominal interest rates or nominal rates of return. It's based on real rates of return. Now, the normal PE is what a company is worth if it earns exactly its cost of equity or its required rate of return. That's what the normal PE is. It's the PE which corresponds to a company that earns the normal rate of return on its investments and which is growing its earnings in a normal fashion. What do I mean by normal fashion? It means that the growth that's being achieved is being achieved through investments that are earning the cost of capital. So it's very important to not confuse this word normal with the idea of saying, oh, the normal PE is the average PE. We take the average PE of all companies and that's the normal PE. No, it has nothing to do with that. Normal earnings, it doesn't have to be as, oh, it's kind of normal because all companies do it. That's not what this term normal means. Normal simply means earning or earnings that are earned at a rate that equals the cost of capital. A company that earns the cost of capital and that is growing its earnings in a way that reflects that its reinvestments are earning the cost of capital deserves the normal PE. All right. So what is the normal PE? I mentioned before that the normal PE is based on the reciprocal of the cost of equity or the required rate of return. That makes sense, right? In other words, if a company is earning exactly its cost of equity, that is the definition of what normal is in this context. So, for example, if the real required rate of return is 6% and a company is earning 6% on its investments, exactly 6% on its investments, then that company should be valued at the normal PE. Now, one of the things that I actually want to point out here that's very important for all of you to focus on is that the PE expresses a relationship between price and earnings, but it's not the only way to think about the relationship between price and earnings. There's a different way to think about it, which is the earnings yield. The earnings yield is simply the inverse of the P or the reciprocal of the PE. Instead of price divided by earnings, it's earnings divided by price. When we say that a company has a PE, for example, of 16.67, it's the same as saying that its earnings yield is 6%. A company who has a cost of capital or a cost of equity, I should say, a cost of equity of 6% real, this company is earning a normal rate of return, then its earnings yield should be exactly 6%. And that earnings yield of 6% is the PE or corresponds to that PE of 16.67%. As you can tell, it's like very, very important that you get your head around this concept. For a lot of people, it's very difficult to make the transition from talking about PEs to talking about earnings yield. But thinking of things in terms of an earnings yield is the key to understanding the relationship between the market value of a company, usually expressed as a PE, and its earnings, and relating that to the cost of equity. Because it's this relationship between a company's earnings and its cost of equity that tells you whether the company deserves an abnormal PE or an abnormal earnings yield, or a normal or even below normal. So again, for a company who earns normal rates of return, its fair earnings yield is exactly equal to the cost of equity. So if the cost of equity of a company is 10% and that company simply earns the cost of capital, what should its earnings yield be? It should be 10%. An earnings yield of 10% is 10 times earnings. That's the way you have to think about it. What happens when a company is able to earn in excess of its cost of equity, its required rate of return? What if a company is able to achieve abnormal earnings growth? Then that company deserves a premium PE. That same company that had a cost of equity of 6% and it's able to earn abnormal returns and have abnormal earnings growth, it deserves a premium. So maybe that company deserves to trade at a PE of 18 or 20 or 22, depending precisely on the extent to which it's able to employ capital at a rate that's above the cost of equity. That's the key. It's not based on growth. A lot of people, most people in the market, and this is one of the biggest myths in the market, people think that you should be willing to pay more for a company that has a lot of earnings growth. That's not true. Not true at all. It depends on how that earnings growth is being achieved. Is that earnings growth being achieved by spending a whole lot of money, and that money being spent is not earning the cost of equity? If it is, then that company deserves a discount, a discounted PE. Even though it's growing really fast, it actually deserves a discount to the normal PE. This is how you really need to think about PE ratios. First, you need to locate what the normal PE is for that particular company, or what the normal PE is for that industry. Then figure out if this company is earning above and beyond the cost of capital, if it has abnormal earnings growth, and then you figure out whether it deserves a premium or a discount to that. Now, briefly then, how do you determine this cost of equity? Because this cost of equity is the all important figure. It determines what the normal PE actually is, and it's sort of the hurdle rate that determines whether the company's earnings are normal or abnormal. This deserves a whole separate video. But very briefly here, the cost of equity has two main components: the risk-free rate and something called the equity premium. The sum of the risk-free rate and the equity premium gives you the cost of equity. The risk-free rate. This is where people start making their mistakes. This is one of the biggest mistakes in finance. 99% of finance professionals, investors, and even university professors think that the way to determine the fair value of a PE ratio is to use as the risk-free rate US Treasury bonds, nominal US Treasury bonds, particularly long-term Treasury bonds. That's incorrect. That's not the risk-free rate that you use to determine the fair value PE, or in particular, to determine the cost of equity. You have to start out with real yield on US government securities. The real yield is net of inflation. It's the inflation adjusted yield on US government securities. Where do you get that? How do you know what that is? It's actually not that hard, because there's a class of securities called TIPS, Treasury Inflation Protected Securities, that have a real yield, and it's inflation protected. Because in the case of TIPS, you get a real yield, you get a yield on this investment. Plus, if there's any inflation, the government actually adjusts the principal amount that you're going to be repaid for that inflation. So you get a real yield. And this real yield is something that you can find, and it's quoted in the marketplace. And that's the yield. It's the real long-term yield on US government securities that has to be used in calculating the cost of equity. Now, the reason for using the real yield rather than nominal yield is the subject of a long video. It's actually an extremely important subject. I hope you subscribe to this channel so that you'll catch the video where I discuss exactly why it is that you need to be using the real yield in determining the fair value PE rather than nominal interest rates or the nominal yield on US Treasury securities. Now, the second part of the calculation of the cost of equity is the equity premium. This is most often called the equity risk premium. However, I think the most correct way to actually refer to this concept is actually the equity premium, because the equity premium doesn't just consist of a premium for risk with respect to the return that you get on risk-free assets. It actually is kind of a grab bag of a whole lot of other things that go into this premium. One of those is called a liquidity premium. Other things have to do with the specific costs of equity ownership, things that have nothing really to do with risk per se. So even though this is generally called the equity risk premium, I don't think it actually should be called the equity risk premium. It should be simply called the equity premium. Now, it's called a premium because the premium is the excess return that investors demand with relation to a risk-free asset. And in this case, it's the risk-free asset, which is the inflation-protected yield on US government securities. So the question is, how much in excess should investors demand for their equity investments than they demand for a risk-free inflation-protected asset? That is something that's actually individual. There's no right answer to this. It's not like there's a magic figure that you can find somewhere that you can calculate somewhere, even if you had a supercomputer that's going to tell you what the appropriate premium is that investors should demand relative to this risk-free inflation protected asset. That's actually going to vary from investor to investor. Every single investor is going to demand and should demand a different premium. But so when we're talking about the cost of equity, this is actually a very individual thing because it's based on largely on this equity premium, and the value of the equity premium is something that varies from person to person. But when you're making an intrinsic valuation, that's actually part of what you have to do. The intrinsic valuation isn't the valuation that applies to the entire market. It's the one that applies to you. Okay. It's the one that applies to you. You need to know what your cost of equity is, or you need to decide or determine what your cost of equity is. Now, there is actually ways in which we can historically assess a range that has prevailed in the marketplace for the cost of equity, and in particular, what we were just talking about, which is the equity premium. This is a whole subject, long video on how to calculate the equity premium. The equity premium actually refers to 4 different concepts People mix this up. They're talking about the equity premium, the equity risk premium, and they're actually talking about four different things. One concept of the equity premium is based on history. It's the historical equity premium. It's simply the excess that has been earned by investors on stocks relative to bonds. That's the historical equity premium. And it's generally been the basis upon which people kind of apply an equity premium in valuations, whether it be PE or discounted cash flow analysis. A second is the expected equity premium. The expected equity premium is generally estimated by academics or sometimes professionals, and it's usually employs what the historical premium has been, but it takes into account various considerations about the present and about the future to sort of estimate what might be expected. Then there's something that's called the implied equity premium. This is something that you kind of back out of market statistics by having an estimate of what growth is going to be and knowing what the risk-free rate on government securities are. You can actually calculate the implied growth rate that investors are expecting. In this case, the implied equity premium that investors are demanding, because we're estimating what the growth rate is, and we're actually trying to determine what the risk premium or what the equity premium is that investors are demanding. That's the implied equity premium. It's not something you're going to find anywhere, but it's something that you can estimate based on estimating what investors expect growth to be and what the risk-free rate is. Now, what's interesting is that historically the implied equity premium, if it's correctly calculated, carefully calculated, has been actually remarkably stable over time. And that's actually very interesting to know. And it's a very useful thing to know, because a lot of people don't really have any idea like how much of an equity premium they should charge. But if you look historically, it's actually been pretty consistent, and there's a range in there where you can know whether the premium that you're demanding is in line with what the market has done historically or it's out of line. Roughly speaking, and correctly estimated, the equity premium, the implied equity premium, has fluctuated somewhere between 5% and about 3.5%. Now, this is lower than what the historical equity premium has been. The historical equity premium is over 6%. But just because stocks have returned more than 6% per annum, more than bonds in the past, that's not a reason to think that that's going to happen in the future. That's not a reason why you as an investor should demand that. That seems like an excessive premium to demand going forward. Now, different people differ in terms of what the expected premium is. But then we can look at what the implied premium really has been historically, and that's what the implied equity premium is. And then the final concept is the required premium. It's the required rate of return. And again, that one is the one, that's the bottom line. That's the individual one. That's the one that each individual investor selects, whether it be explicitly or implicitly. Because when you buy a stock at a certain PE ratio, implicitly you have in there, you're making a decision on what your required rate of return is and what your equity premium is. Whether you even know what the equity premium is, implicitly, that's what you're doing when you're buying a stock at a certain PE ratio. Again, you have the real rate of return on long-term government securities. That's the risk-free rate. We add an equity premium to it. Just as an example, currently, the long-term yield on TIPS securities in the United States is approximately 2% right now. What equity premium are we going to use? If you use 4%, which is a little bit towards the lower end of what it has been historically, and it's certainly at the lower end of what most academics estimate it to be, then the sum of that 2% and 4% gives us 6%. Remember that I mentioned that 6% as a cost of equity translates into a normal PE of 16.67. The normal PE is simply companies that are earning that cost of equity. That cost of equity of 6%, which I've just explained to you how I constructed it, that's the rate of return that investors demand. When companies simply earn that hurdle rate, when they earn that, that company deserves a PE of 16.67. Now, if you think the cost of equity is greater, because, for example, you might think, well, look, the equity premium, I really think it's 5. And so instead, I'm going to use 7% as the equity premium. And so therefore your earnings, then the fair value, the normal P is going to be lower than that. If you think that maybe the equity premium should be 8%, then your estimate of the normal PE is going to be substantially lower than 15%. It just depends. The normal PE, which is the starting point for all valuation on a PE basis, is based on the cost of equity. Whether you are aware of it or not, when you buy a stock at a PE ratio, implicitly, there's a cost of equity that's embedded in there. It's a decision that you're making. Now, the best thing is for you to actually know what decision you're making, to know like what it is that you're doing when you're buying a PE, for example, at 16.67 times its forward earnings. What does that mean? That means that my required real rate of return for a company that earns its cost of equity, that earns that cost of equity, is 16.67 times. That's the normal PE that company earns, because the cost of equity is 6. The company earns 6%. Its fair value PE is 16.7. The fair value in this case, the fair value PE is the normal PE. The normal PE, based on my cost of equity, which is 6, is 16.67. But I might be able to find a company that is able to earn in excess of the cost of capital. And in that case, that company's fair value PE is higher than 16.67. And exactly how much higher depends on how much higher it's able to earn in excess of the cost of capital and for how long. Now, this is the final point I'm going to make in this video because it's already getting too long. Investors make a lot of mistakes when they think about PE. I already talked about one of the big mistakes. One of the big mistakes they make is that they use the nominal risk-free rate to determine the cost of equity. That's just flat out wrong. Second mistake that investors make is that they think that stocks deserve a premium to let's say the average PE in the market simply because they grow at an above average rate. That's false. It's simply false. It's also false that if a company grows at a much lower rate than average, that it deserves a lower P. That's not true at all. The PE ratio that is the correct one from a valuation standpoint is based on the capacity of a company to earn above or below its cost of equity. The third big mistake that people make is implicitly assuming that companies are able to earn above and beyond the cost of equity for a long time. So people can overestimate how much above the cost of equity a company can earn. They might overestimate the company's earnings growth and therefore its abnormal earnings growth, and they might overestimate it. But even more than overestimating the extent of earnings growth or overestimating the extent to which a company can earn above the cost of capital in any given year, the issue is for how long can it do it? Economic theory, but also empirical evidence shows that the rates of return earned by companies over time revert to zero. In other words, abnormal profits revert to zero. Another way of saying is that abnormal returns simply revert to the cost of equity. No company is able to earn above and beyond the cost of equity forever. That's actually simply an impossibility. It can't happen. And certainly it can't happen when you're talking about an index as a whole, right? Not every company in the United States or not on average can companies actually earn above and beyond the cost of equity, nor can they experience abnormal growth indefinitely. And so it's a big mistake to pay a really high PE when that PE is based on an assumption that a company that's earning abnormal earnings today or earning abnormal earnings growth today will be able to continue that on indefinitely into the future, because that's simply not true. They might be able to do it for a couple of years, 3 years, 4, 5 years. In very, very rare cases, some companies have managed to earn above and beyond the cost of equity for a decade, but even that's extremely unusual. But when you're talking about the market as a whole, this idea that the market as a whole, that all 500 companies in the S&P 500 index on average can earn above and beyond the cost of capital, it just can't happen. It can't exceed it by very much, and it certainly can't exceed it for very long. So that brings us to the final point. Your basic starting point for valuation is understanding that your benchmark for valuing a company on a PE basis is based on the normal PE, because the general assumption should be is that companies cannot, in the long run, earn above and beyond their cost of capital. And remember, the PE ratio is on a long-term estimate of a company's earnings power. In the long term, companies cannot earn above and beyond their cost of equity. They can do so for a fairly short period of time, and that has to be factored into their valuations, but they can't do it forever. And when we're talking about the market as a whole, we know that the market as a whole cannot earn above its cost of equity by a very large margin, and it can't do it for a very long time. So therefore, valuations should always be very close to that which is implied by the cost of equity. It's the fundamental basis of all valuation. You have to have a really good reason for being willing to pay for a stock more than what is indicated by the cost of equity for that particular stock. And when it comes to the market as a whole, it's very rare that you should be willing to pay a PE ratio for the market as a whole that is in excess of what the normal PE is. Because as I said, the market as a whole cannot earn abnormal profits for very long. It can't earn abnormal earnings growth for very long. As such, the market should generally be valued at the normal PE. Now, there's special times when maybe there's prospects that because of something happening in the economy, something going on, that companies may be able to generate abnormal profits for some period of time and generate abnormal earnings growth. And that's going to give them a little bit of a premium, but that's about it. So let's just look at the S&P 500 today. I mentioned before, we have the trailing PEs that are pushing up against 30 times, the forward PEs that are about 24, 22 based on operating earnings, based on GAAP earnings, probably in the somewhere around 25 times earnings. Now, what's the cost of equity? I mentioned to you before, 6% is probably a reasonable estimate of what the real cost of equity is for US equities. That would imply a normal PE of 1667. We're way above that. What that suggests is one of two things. One possibility is that the market is pricing in a very low equity premium. The market is very complacent and is pricing in a very small amount of risk. That's a possibility. I don't actually see evidence that that's actually the case. And the other thing that we have to understand is that, again, historically, when we look at the behavior of the equity premium, it's actually been pretty constant. The very high PE ratios in the market right now seem to be based not so much on the idea that investors are charging a lower equity premium. It seems to be that it's based on the fact that investors are implicitly expecting a tremendous amount of abnormal returns on investment and abnormal earnings growth. In other words, they're expecting companies to be able to earn a lot on their internal investments and to be able to achieve abnormal earnings growth. At least that is implicitly what's implied in valuations. But this is where we get to our big mistake that's been committed historically, which is that we have to understand that the market as a whole cannot earn above the cost of equity for a very long time or to a very large extent. So it's generally a big mistake to pay for the market as a whole a valuation on a PE basis that is a premium to the normal PE. And I think this is related right now very much to what's going on in the tech world. There are the high valuations in the market are actually narrowly concentrated. Most sectors in the market are actually relatively fairly valued right now. It's really high-tech companies, and particularly companies that investors believe are going to be benefited by AI, that are receiving extremely high PE ratios of 30 and 40 and even more. And those valuations implicitly are saying that investors think that those companies are going to be able to generate abnormal returns and abnormal growth to a very high extent and for a very long time. historically has been a mistake. Even if you're a big believer in new technology and its benefits, the fact is that in a capitalist system, abnormal profits tend to be competed away. And the rate of return on investments tends to go down to what the cost of equity is. That's historically what it's been. And that should probably be the general operating assumption that you use. Now, there's a way of actually being able to estimate what sort of assumptions are being made in the market regarding growth. If I use some really conservative, or you could argue aggressive assumptions about the equity premium, put it around 4%, overall cost of equity at 6%, it implies that the PE ratio that we're seeing right now in the market is implying that investors are expecting earnings to grow at something like 15% per year for the next 5 years. Now, that's extremely unlikely. First of all, that rate of earnings growth is very unusual, but it's absolutely unprecedented at a time when the economy is at near full employment. When the economy is near full employment, generally two things happen. Earnings growth slows down, economic growth slows down, meaning that earnings generally slow down, and generally a recession is right around the corner. Historically, when the economy has reached full employment, it has virtually never been the case that after an economy reaches full employment, a recession doesn't happen within 5 years of that. So the idea of expecting 15% earnings growth in the next 5 years is extremely unrealistic for those two reasons. First of all, because historically speaking, it's very likely that we'll have a recession sometime within the next 5 years. And so therefore, it'll be impossible to have that type of earnings growth because during a recession, earnings collapse. And the second reason is simply that even if we don't have a recession, the economy is going to grow relatively slowly and earnings will grow relatively slowly. So this implied assumption in the market that earnings are going to be growing at these tremendous rates really doesn't make a lot of sense economically. It doesn't make sense historically. Now, that doesn't mean that you should go out and start selling stocks in a panic. It just means that stocks have very limited upside in a sense, and they're very dangerously positioned right now. Because if anything happens in this market that punctures these unrealistic expectations about growth in the next 5 years, it could cause valuations to collapse back down to a more normal level. For example, and when I say normal in this case, I don't just mean back down to the average PE of 15 times. Maybe it'll collapse back down to a normal PE, which assumes that on average, companies will earn the cost of capital. If on average, companies earn the cost of capital, the fair value PE for the US stock market would be 16.67% based on a cost of equity of 6%. The problem is that right now is that the market is implicitly assuming that there's going to be a lot of abnormal earnings growth. And that's why it's pricing the market at a forward earnings multiple of 22 to 24 times based on operating earnings and over 25 times based on GAAP earnings. But again, that assumption of extremely high growth in the next 5 years is very unrealistic. It's unlikely to happen. And sooner or later, investors are going to get a wind of it. And people are going to figure out that they're expecting too much. They're expecting too much growth. And when those expectations get pricked, get punctured, that's when there's a risk of a pretty major market decline. Now, that concludes my very long presentation today. I hope you still enjoyed it. There's a lot of stuff in there. And as you can tell, I really need to elaborate more deeply on some of the points that I talked about in this video. Now, just so that you can laugh, I expected this to actually be a fairly short video. I thought it was going to be like a 20-minute video where I talked about the fair value PE. But as I did this, I realized that you have to get into so many different things in order to even superficially talk about how to calculate a fair value PE that this video ended up running pretty long. So what I want you to do is I want you to subscribe to this channel because I'm really going to post several videos where I go into much greater depth on some of the subjects that I promised in the course of the video. I must have said at least 5 or 6 times in this video that I need to make a video on that subject, and I will. And it's very important that you actually understand each and every one of those subjects. You need to understand what a normal PE is. You need to understand what abnormal earnings is. You need to understand what abnormal earnings growth is. You need to understand why anybody should pay a premium or a discount to what a normal PE is. These things are so important as an investor. If you don't understand these things as an investor, you're literally blind. You're flying blind. But you know what? This is the truth. I've been in the investment business for a long time. The vast majority of professional investors don't know how to calculate a fair value PE or the intrinsic value of a PE. They're flying blind, and no wonder the performance of financial professionals is so low and so abysmal, because they don't even understand the basics. But you can understand the basics. It's not something that's that difficult, but it does take some diligence. And my goal is going to be to transmit these ideas to you in a way that you can fully grasp and you can fully understand. And I guarantee you that it's really going to be worthwhile for you to learn these concepts. And some of you, for example, that have taken the CFA and have received credentials like that, that's great. And that's going to be very useful. But quite frankly, a lot of these concepts which are taught in the CFA are not really grasped all that well by the individuals that study for this test. They study to be able to solve certain problems sort of mathematically. They're solving some word problems and some math problems. But really the fundamental concepts of what drive these things are something that people haven't thought about enough. And in this channel, a lot of what I'm going to be doing in this channel is education, it's mentoring, it's showing how you should really think about things like valuation, things about the PE ratio, because we talk about PE ratio so much, but people don't know what they're talking about. And I don't want that for you. I want you to know what you're talking about when you say that that PE ratio looks high, or that PE ratio looks low, or the stock looks cheap. I want you to know what you're talking about, because if you don't know what a fair value PE is, and you say something about a PE ratio, then you really don't know what you're talking about. So one of my goals in this channel is really to help people understand fundamentally what it is that they're doing as investors. So thanks a lot for joining, and we'll see you soon.